Ackman is at it again, moving the biggest and most liquid market in the world, the US bond market. But it's not just him. There are a huge number of individuals getting on board the long bond trade as cracks in the economy start to pile up. With the resilient labor market finally slowing down, key inflation data due tomorrow, and the SP 500 hitting our key target of 4,600, could the bears finally get their moment? Let's talk about it. Hello ladies and gentlemen, welcome to the daily recap show where we talk about stocks and the financial markets. If you like this video, please subscribe, hit the notification bell. Let's get into it. If you looked at the SP 500, you think today was extremely red. But if you look at this, it was really only red in the big players. Concentration risk was your downfall today if you are concentrated in the big names. But if you actually dive a bit deeper, you saw that inside technology, software as a service bid up, semiconductors were bid up, healthcare, financials, especially regional banks right here, put up a very green day. Definitely a broadening out, except in utilities. They just were hated. But all in all, it was, a broadening out and rotation from the bigger names into, these smaller names. And this is something we spoke about on Friday and something we're seeing. We're still yet to determine if what we're seeing is a broadening out of the market or a rotation from growth into defensives. And if you actually have a look at the best performing sectors right now, GDX up 5.81% for the last 5 days. Real estate, materials, home builders, staples, financials. What do all of these have in common? They're defensive style stocks. But if you actually have a look at the worst performers over the last 5 days, semiconductors, solar, communication services, growth style stocks. And actually these defensive stocks are actually outperforming the SPY. Like I said, we could be seeing a rotation from growth into defensives or just a broadening out of the market because a lot of these growth names encompass the bigger players. And that's simply because big money could be seeing something we're not. They could be sensing a recession. And I have some data here for you. Recessions are painful for equities and hardly discounted in advance. In the median recession related drawdown, 81% of the losses happen during the actual recession. And it's quite simple. During recession, people get scared, fear breaks in, people get emotional and they want money and they sell stocks. And selling of stocks leads to more selling of stocks. It leads to systematic flow. CTAs start selling and everybody just starts selling and you get these capitulations. And this is why in recessions, you get these massive, 44% drawdowns, 25%, 57% in 2009, 2008. And that's why over the next few weeks, I'm going to talk to you guys about downside protection and capital preservation. If we do go into a recession, what we can do beforehand to protect our portfolio. But for now, the market is still in, and I have some data here for you. Recessions are painful for equities and hardly discounted in advance. In the median recession related drawdown, 81% of the losses happen during the actual recession. And it's quite simple. During recession, people get scared, fear breaks in, people get emotional and they want money and they sell stocks. And selling of stocks leads to more selling of stocks. It leads to systematic flow. CTAs start selling and everybody just starts selling and you get these capitulations. And this is why in recessions, you get these massive, 44% drawdowns, 25%, 57% in 2009, 2008. And that's why over the next few weeks, I'm going to talk to you guys about downside protection and capital preservation. If we do go into a recession, what we can do beforehand to protect our portfolio. But for now, the market is still in greed. Neither the bears nor bulls are winning. It seems that all rallies are getting sold into and all dips are getting bought. It's just the nature of the market being in positive gamma. But we did have earnings today and very good earnings by both Salesforce and Snowflake. And if we actually break down Salesforce a little bit more, and I think I'm going to break down this further and do a full fundamental analysis in my weekend video. So go ahead, subscribe so you don't miss that video down below. Salesforce produced $18.1 billion worth of revenue, 13% year-over-year growth. And I think the story behind it is stuff like Slack, MuleSoft, and Tableau. 22% year-over-year growth, 11% year-over-year growth. And these used to be headwinds to the Salesforce business, which are now tailwinds and actually contributing positively to their overall revenue. And I think this is why tech insiders were buying into Q4 earnings. We saw a lot of buying from corporate tech insiders in the XLK or stocks inside the XLK. And this is why we had a signal corporate insider buying right there on about the 25th of November. Very interesting to see that Salesforce, Snowflake produced good tech earnings. Now, moving on to volatility. Volatility has been absolutely crushed. We have seen some signs of life come into volatility today, yesterday, but overall, if you look at it, we are approaching near 5-year lows. Very similar to where we were in 2020. Now, a lot of people are expecting some form of a volatility explosion inversion. I don't think that's actually going to happen. It very well could. I don't think it is, simply because option selling is so huge in the market, and that just compresses volatility. It puts us in a state of positive gamma where rallies are met by selling and dips are met by buying. And that's exactly what we're seeing in the market right now. And I do think we're probably going to go below the 12 area, maybe even into the 11 zone in December. Now, this is the forward 6 months performance of the VIX, and this is the decel 2 observation. So pretty much when we're in the, the 12, 13 area, the returns we can expect upward returns of 10% and downward returns, of about 10%. So if you actually have a look at the 12-month returns when we're in here, on average, you get about 10.3% 12 months later, about 4.5% 6 months later. So a low VIX is not necessarily a bad thing, guys. It's just the environment we're in. It's implied volatility, and a lot of it has to do with dealer hedging activities. Now let's talk about the economy and bond yield. Global bond yields gained 4% in the month of November, and November isn't even done. They're literally rallying like they were in 2008. This was the gains in 08. And this could be a flight to safety. This could be because bonds have been severely sold in the last 2 to 3 years, not just in the US, across the world. But I think a lot of people are seeing signs in the economy, the US economy, the global economy, that things are not looking too good. Bill Ackman bets the Fed will cut interest rates as soon as the first quarter in 2024. He sees risks of a hard landing if Fed doesn't cut. And Ackman said he observed evidence of a weakening economy, and we are actually seeing that in the job market. We did get a very good 5.2% GDP print today, but there are some telltale signs in the credit market specifically, as well as the labor market starting to appear right now. And tomorrow we do get inflation data, the Fed's preferred inflation data, so it's going to be really interesting to see how that comes out. And bonds are a hedge against deflation, guys, and the latest Fed nowcast has inflation month over month as negative. So in the earnings calls last month, Walmart and these retailers, a lot of them were noting deflation, and we are actually starting to see this in the nowcast month over month CPI data. And I think tomorrow's inflation data is going to be interesting because we could start to see some of these deflation metrics really take hold. And if that's the case, the bond trade is just going to get even better. And this is one of the reasons why I said, in the middle of November, early November, it says here November 14th for me, it would be November 13th for everybody in the US. George Soros has loaded up on TLT calls. Ackman has joined the long bond party too. And I started building out my long bond position. And a lot of this trade is predicated on what Ackman said, the prediction of rate cuts. And there's been some massive changes in the 30-day Fed fund rate futures. Have a look at this right now. I want you guys to pay close attention to this. This is the rate where we are right now, the target rate, 5.25% to 5.5%. We were expecting 4 rate cuts to around this level right now. We are now expecting 5 rate cuts to the 400 to 425 basis point area. And have a look at this, a 17.7% chance of a 375 to 400 basis point rate cut. And from where we are right now to there, that's 175 basis points. To the target rate of 400 to 425, that's 150 basis points. And these are the returns we can expect with 150 basis points. If rates are to fall by 1.5% all of next year, we can see in the 20-year bond a 26% total return and a 33.5% return in the 30-year. Very, very bullish on bonds if we do get those rate cuts. Now, a rising tide does raise all boats, and if rate cuts do come next year, this is extremely bullish for gold. Every time the Fed paused and cut rates, gold rallied 66% in the year 2000, 189% from 06 to 012, and 50% in 2020 around COVID. And this is where we are right now. Cuts do come bullish on gold. Let's talk about stocks and December seasonality. December tends to be quite a bullish year in the pre-election year, up nearly 3%, 72.2% of the time. But this is normally coming off a very average November. And this is what we can expect in December after a bullish November and a bullish year. 88.2% of the time, December is positive. So we are expecting further gains into December. And this is what it can look like on a day-to-day basis. Normally we see some pretty flat returns all the way up until the 16th. And then the 16th is when we take off. What is happening on the 16th? That is OPEX. Quad witching is happening on the 16th of December. And it seems after this period right here, we do see some outsized returns in the month. And this is aggregate for all years, 1929 to 2022. So quickly, before we hop on the charts, I want to show you some gamma. And the 4600 level, this level we've been eyeing all week, finally got hit, guys. Now this is the chart we've been following, actually went and hit the 4600 level. In fact, we were just below it, getting at 45.97, and that's what I said in yesterday's video. I was expecting us to go ahead, hit the 4600 level before we can see some sell side, and it was very obvious we're going to do this. 4600 was a very high gamma strike. Dealers probably wanted to get up there, hedge their positions before the December OPEX. Now this is the 4600 level, the high gamma strike. This is the 4495 level. This level is where we go from positive gamma into a negative gamma environment, and above here we're in positive gamma. And one thing I want to stress is that if we go ahead and close above the 4630 level, 4637, if we go ahead and have a daily close and maybe even a weekly close above this level before the 16th of December, that is bullish. That is very bullish. And if that's the case, there is possibly a chance that we go ahead and break all-time highs before the end of December. Now, I'm not saying we do, I'm just saying there is a possibility that that happens. But regardless, if we do go ahead and close above this level in December sometime, I do think we go ahead and break all-time highs in 2024. That is my prediction. I think 5,300 2024 will trade. But for now, the index did exactly what I said it would. We went up to this high gamma strike, we got sold off, and we have to see what the inflation data brings tomorrow. Now, there are still some risks lying ahead. There is a lot of negative gamma forming here right below the 4550 level. If we do get below this, you know, we could see some pretty intense selling all the way to about the 4420 level, 4520 level. But, you know, dealers should step in right here. And I am still bullish to break above the 4600 level in December. Now, let's look at some dark pools. I only have one chart for you guys today, the 3x bull ultra QQQ. Huge trades came in here. You know, normally when you see this is a sign to go long, especially when you've determined a low. And we saw one trade come in today, the 12th biggest trade since inception, and it's nowhere near as big as any of these. What does that mean? It probably means that a lot of these guys at this level still have all of their trades open. Now, looking at economic data, we had GDP came in, the preliminary data for GDP at 5.2%, but we do have PCE consumption tomorrow, month over month, year over year. Big data, guys. This is the Fed's preferred measure of inflation. And then we have ISM and Jerome Powell speaking on Friday. I don't think Jerome Powell speaking is going to do much of anything. He's just going to say higher for longer. If we need to cut rates, we will. If we need to raise rates, we will. We also have jobless claims on Thursday tomorrow, as well as OPEC. So big day tomorrow. Big day tomorrow with PCE, initial jobless claims, and OPEC, guys. But if you've made it up until this point in the video, thank you so much for watching, guys. Please go ahead, subscribe, hit the like button, hit the notification bell, leave a comment. You know I love you guys.